everybody. So today we will be going over navigating the market cycles. And more importantly, there's this saying, don't fight the Fed. The Fed controls a lot of things, and it impacts. If you're an investor, if you own a business, if you're trying to sell a business, if you're trying to buy a business, if you are trying to buy assets, there's certain behaviors, when to play offense, when to play defense. These are very important to understand. And if you understand the Fed and what they do and what stage we are at when it comes to the market cycles, then you'll be able to navigate through the times and, more importantly, maximize the return. So at the end, also in this video, I will be going over the opinions of great investors such as Warren Buffett, Druckenmiller. There's great investors, what their opinions are when it comes to navigating the market cycles, and also how to deal with the Fed and the Fed's behavior. But first, if you do not know, the Fed is the Federal Reserve. It is the central bank of the United States. It is arguably the most powerful economic institution in the United States and perhaps the world. The Fed is responsible for managing the nation's monetary policy to promote maximum employment, stable prices, and moderate long-term interest rates. It also plays a crucial role in maintaining financial system stability, supervising and regulating financial institutions, and protecting consumers. Additionally, the Fed acts as a lender of last resort during periods of economic crisis. Now, the Fed influences the economy through various tools, such as setting interest rates. The Fed sets the federal funds rate, which is the interest rate that the banks charge each other for overnight loans. This rate influences other interest rates in the economy, affecting borrowing costs for individuals and businesses. Managing the money supply, the Fed can increase or decrease the money supply through open market operations, which involve buying or selling government securities. Quantitative easing. In times of economic crisis, the Fed may engage in QE, which involves buying large quantities of assets like government bonds and mortgage-backed securities to inject liquidity into the financial system and lower long-term interest rates. Now that we know what the Fed is, now we're going to be going over the behaviors of when the Fed does a certain type of action. Now, if you're an investor, like I said, there's a saying, don't fight the Fed. And basically what that means is you have to, as an investor, the phrase advises investors to align their strategies with the Fed's monetary policy. So what does that mean? So if they are on the expansionary policy, right, lower rates, what you should do as an investor, you should invest aggressively in risk assets, stocks, real estate, buying businesses. You want to play offense. Okay, these are the things that you should do. You have to know when to play offense, you have to know when to play defense. And this is an offensive tactic. You want to be aggressive. Okay? Now, on the contractionary policy, when they raise the rates, you want to shift to defensive assets. What are defensive assets? Bonds and cash. Now, why is this important? Well, the Fed controls the cost of capital via the federal funds rate, which cascades into borrowing costs for consumers, businesses, and governments. This impacts corporate earnings, valuations, and economic growth. So there's key components here. All right, you have to understand these key components. Interest rates transmission. So basically, when there's lower rates, there's going to be cheaper loans, and with cheaper loans, there's going to be higher spending investments, which means it is the economic expansion. So it trickles down. Let me say that again. Lower rates leads to cheaper loans, leads to higher spending investment, which leads to economic expansion. Now, there's going to be asset price inflation. So with low rates, reduced discount rates, it boosting the valuations for stocks and real estate. Now, there's going to be an impact to this. We have to understand the psychological impact. The markets often rally on rate cuts. Let me say that again because this is very important. The markets often rally on rate cuts and sell off on rate hikes. Sell off on rate hikes. All right. Now, let's go over some case studies. 2008, okay, the global financial crisis. The Fed's action, they slashed the rates to 0% and launched a quantitative easing. The market response, S&P 500 surged 200% from 2009 to 2020 as liquidity flooded the markets. Lesson here. Investors who followed the Fed profited from equities and real estate. Okay. From 2020 to 2024, the rate cycle, the cut rates of 0% during COVID, then hike aggressively, okay, to combat inflation. Equities, so the response to that was, the byproduct of that behavior was equities initially crashed in 2020, then rallied on a stimulus, but corrected in 2022 as the rates rose. And on 1980, the Volcker era raised the rates to 20% to kill inflation. The response and the byproduct and the outcome of that was recession and a bear market, but set the stage for an 18-year bull market. So there's action, and then there's going to be a reaction. So it's very important for you to understand these type of things. Now, let's go over the perspective of legendary investors and what their thoughts are when it comes to navigating the market cycles and also the Fed. With Warren Buffett and Charlie Munger, they focus more on the long-term value, but they also acknowledge the macro trends. And what they do is buy great businesses and hold for a long term. So they don't really, yes, the market will definitely dictate their behavior when it comes to cash, getting more cash. But when it comes to buying great businesses, they typically hold it for a long period of time. They focus on the product, the great delivery of the product and service, the moat, and more importantly, the cash that it will return to them. Now, when it comes to Stanley Druckenmiller, he said, don't fight the Fed, but don't ignore valuations. That was his advice. Howard Marks, he said, Fed policy is a tool, not a crystal ball. Okay? It is a tool. It is a tool to be used. And these are going to be, there's strategies that you should apply when the Fed is doing an expansionary policy or process or contractionary. And the conclusion is to master this phrase, don't fight the Fed. Okay. You have to monitor key indicators. These are signals that will then give you a better data to make better decisions. And the signals are the Fed statements, CPI, unemployment, and yield curves. You have to also balance the macro With the micro, use the Fed policy as a compass, not a map. Pair with fundamental analysis. And the most important thing is you have to be adaptive. As an investor, as a business owner, as an executive, a CEO, or somebody that holds a holdco, operates a holdco VC, you must stay adaptive. Historical patterns are guides, not guarantees. They're just guides. They're not guarantees. And I'm going to finish it off with a great quote by Howard Marks. And he said, "The Fed is like the weather. You can't control it, but you can prepare for it." With that being said, if you found value in this lesson, in this class, in this navigation of this market cycle, and the quote, understanding the quote, "Don't fight the Fed," I want you to subscribe and share and stay tuned for my next amazing. Also, comment down below. Say something, say anything. You like it, you dislike it. I just want to hear and see your feedback, okay? With that being said, stay tuned and I'll see you next time. Peace.